Good morning, traders. Today is May 8th, early Sunday morning on Mother's Day. I'm doing the update. I'm going to give you a brief update of what's going on and what to expect next week. We've seen quite a bit of selling in the markets, which is expected given the rollover of the global markets over the past 10 plus months and the decrease in trader expectations related to the Fed and a contracting economy, a number of other issues. We've talked about it in the past. COVID in China, the lockdown, supply chain disruptions, rising interest rates, putting pressure on house prices, consumers pulling away a bit, rising gas prices, lots of things going on. But what is happening right now is kind of interesting in the sense that excuse me, that we may end up seeing some sort of a bottom setting up in the market over the next couple of weeks as traders start to bargain hunt and realizing that even a moderate contraction may not be disastrous for the markets as long as the Fed stays fairly moderate and the unwinding of excessive credit throughout the globe can be managed. So the Fed has moved interest rates up to about 1% after the two rate raises. We started at a quarter percent and then moved to a 0.5%, and now we're at 1% with the half a point interest rate. Powell is talking about being much more moderate than everyone is expecting. So you're going to hear a lot of comments about three quarters or 1% rate increases over the next month or so. And I believe Powell will come out again, probably with a quarter percent or maybe a 0.5% raise. 0.5% could be kind of dangerous. Quarter percent is less dangerous. And I'll show you here I'll have to find it. My modeling system suggests that 1 to 1.25% is the upper boundary for interest rates right now with all of the debt in the market. So we're nearing upper boundaries right now, and let the markets adjust and see what happens. But first, what I wanted to show you was this chart. This is the US stock market index in blue compared to the global market index. You can see we had a peak back here in 2018. This was right after the elections in 2016. You can see this big peak here in the global markets. This was a ramp up of purchasing, lower taxes, Trump administration. This was a very big global ramp up. And the US markets recovered very nicely and then moved into some rotation in 2018 and continued to rotate 2019 just before COVID. Now, what we have right now, ladies and gentlemen, is COVID collapse following the recovery. This is the election here in November 20 and 20. And then we had this big speculative wave take place where the US markets rallied with low Fed, quantitative easing, huge speculation, huge reinvestment into mutual funds and others by traders. And you can see the global markets, the red line, has come all the way back down into this support zone. And I've drawn this support zone back through 2014, 15, all the way across here in 18, 19, deep COVID lows. This was a deep low 2015, 16 in the global markets. Now, obviously, we could see the global markets come back down to these levels. You can see they're making moderate highs going higher. And that's why I think this is a good solid support level for the global markets. With regards to the US markets had rallied, continued to move downward. And you can see here, we had about a 25 to 30% correction here in the markets. You can see we retested these levels over and over again. I don't believe the US markets are going to see this type of a downtrend. I think they could be forming support across this low around 2020. And if we get below that, then we start looking at the 2019 and 2018 highs as far as support. So understand that would put us right around this area here. But still, I believe this deeper rotation in the global markets, pulling the US markets down, even though the US dollar is stronger, the Fed is being fairly moderate. I believe this is going to pour capital into the US assets, US stocks, ETFs, and other assets. And I believe that it's going to basically be a process of unwinding capital investments in the foreign markets, and it's going to continue to provide support for the US markets. So we have this dynamic taking place. And you can see this dynamic taking place here. Actually, you can see it here as we had the election. that we move into the 2015-16 timeframe. This is the pre-election consolidation, global markets. They don't know what's going to happen with a new U.S. president, new U.S. policy. U.S. markets contracted, global markets contracted. Then we get the election clears the way. We start to understand what's going to happen, and we started to see a very big ramp up in global markets. This was mostly Asia and Europe. But the US markets continued to move higher as well. Why did Asia start to move higher? Well, because we moved from an unknown transition into a known scenario, pushing the markets higher on renewed economy and renewed global activity after the election. We moved through here. This is when the Fed started raising interest rates. We had some concern with China. Trump and China, with regards to the sanctions, started to deflate global markets a bit. So we see a little bit of a recovery. Then we have COVID, destroys the markets, moves everything down very quickly. We see this broad recovery in the global markets as well. Now, remember, at this time, China and Asia and everyone were still going through COVID concerns, but we had this strong recovery nonetheless. Now you see that we've seen this wipeout of the global markets, which has really done some damage. I mean, it's the same type of wipeout we saw here, even bigger, back in 2018. And we're not in an election year. This is just a wipeout of economic concern related to over speculation, what have you. And we're down here near these lows again. And I'm believing that these lows are very likely going to find some very solid support over the next couple of weeks, possibly putting in a bottom. Might take many months to do so, but the US markets might also try to attempt to find a bottom. So now let's take a look at our here our custom indexes. So the FANGS index, this is the FANGS index, has come down to this middle standard deviation channel, actually just below it. You see it was down 3.16% last week. We've rolled over, we've come back down, we've essentially wiped out from 1300 to call it 885. So that's going to knock out, do the math real quick, that's about 450. So that's about a 20, if I do the math right, 25 to 35% downside move. And what's happened here is we've wiped out quite a bit of assets with regards to the expectations of technology. This is Netflix, Disney, all, Amazon, you name it, Microsoft. And so we're in this area now where historically, I believe we're getting near a bottom. We might be looking at 1 or 2 more weeks of bottoming sideways activity, maybe a bit more. But I think we're going to start to find a bottom and maybe start to really come out of this with a nice little 10 or 15% upside move. And it's really, this is the devaluation phase that I was expecting through this. And we'll see how things continue. But we're seeing a deep enough capitulation in trend that I believe we're now at a point where we can go ahead and start to establish that this might be the deep pullback low causing the end of wave 4, which I believe this is a wave 4 downtrend to start a new wave 5 uptrend. You can see here COVID, even the COVID collapse, from let's call it 750 to 500 here. This represents about a 30% decline. This represents about a 35% decline. Back over here in 2018, we had a similar type of scenario. This is what I consider a capitulation. At this point, I'm thinking that things might start to change in the way capital is seeking opportunity. There might be some opportunistic buying mode here. So now the US stock market index has pulled back from about 1350 down to 11. So that's about, to do the math real quick, 250. That's about a 22% decline. We're still in this upper channel. Again, I'm trying to show you this standard deviation channel because if you look very long term at trend slope, you'll see that we've pushed way outside of this range and now come back down. We could still find some support here in the S&P and the Dow Jones, although I will warn you, we still have this gap from roughly 1100 down here to about 1,000. So potentially another 10%, 20, 15% down into this green area here to really try to find support. Now, luckily, you can draw lines right across here, right across these lows, straight across to here. And you can see that we're nearing some historic support from back over here in 2021. But we'll see how this holds up. If we see some support here hold, we might see the stock market try to move into a sideways mode here. Now, I'll draw this on the chart, but ideally, if this is a big washout pattern and we're looking at more risky downward trending, then we're going to see some sideways activity maybe for 2 to 4 months before it starts to break down even further. Okay, so the Smart Cash Index, which is the global market index, is setting up this very interesting double bottom pattern right now. I believe this double bottom pattern potentially could be another sign that the global markets and traders, investors are starting to potentially bottom hunt. You can see that we're back down here into the lows of 2019 or 18, sorry. We're back into the lows of 2019. We're back here in the midpoint area of the COVID recovery. Be honest with you, ladies and gentlemen, if it gets much below this level, down into the 135, 130 area, down in this area, this would be a very deep pullback globally. And I believe some bargain hunters are really going to start to move in at this point, knowing that we've seen a big influx in capital, a big influx in growth and spending. Consumers are still moderately strong, even though a large portion of the weaker consumer side is pulling away from the market. The long and short of it, again, ladies and gentlemen, is I think we could see a pretty big bottoming buying phase over here. Okay, metals index, very interesting. The metals index, you can see I've kind of drawn some charts here. This is weekly. I believe that the metals index are holding up quite strong considering the US dollar strength. And I'm going to explain this to you. So over the past couple of months, the US dollar's really been performing quite well, holding up quite strong. Normally, this would put a lot of pressure on metals, but metals have continued to move in an upward channel. You can see this deep, deep bottoming, and this is my custom metals index. They've continued to perform higher. Now, when fear hits the market, like we had over here in COVID, we had over here in the deep decline during 2018, you can see that metals typically move lower. If we move into a deep downward trend, then yes, metals could potentially move lower and break down below this channel, maybe coming back down into these lows around 400 on my index, trying to find some support. But overall, metals are holding up extremely well. They're holding up near the highs. We've seen this deep, deep pullback just recently, the last 3 weeks, which is expected given the type of rotation that we've seen in the markets. So I'm going to tell you right now, metals are holding up very, very well. And I think after this selling ends, if we get a bottom, if we start to see the market find some support, metals will recover back up to near their highs, possibly above 2,000 for gold, above 28, 29 for silver, and begin to really appreciate as we've entered this new phase. And again, as I've told you, we've got 5 to 7 years of upward trending in metals. So be prepared. This could be a very good buy opportunity. The valuations index continues to move lower. This is showing us that we've seen a very deep decline in overall expectation with regard to valuations in the stock market. You can see we've seen these very strong highs. This was again Fed stimulus, growth in the economy, lower taxation, consumer spending, buying, a really strong economy at this point. Then we see the COVID spike, the COVID speculation, the COVID peak. We see this devaluation phase, which is where the markets roiled back after the election. So here's our 2020 elections right here. Then we had a change in the valuation phase, and then we started to see some accumulation. This is telling us right now that we're getting back down here into near normal lower levels. So I would expect, again, 61, 62, maybe 58 to try to find some support. If it gets much deeper, we're going to start to see a bottoming, a really big bottom in the markets, like a big blow off low, but it's down into normal levels. And I believe we're going to see it continue to move sideways, maybe devalue another 4, 5, 6, 7%, and then start to find some sort of support here. You can see it was down 6% last week, whereas look, the metals index was only down 0.77. The smart cash index was only down 2.59. The U.S. stock market index was down 0.78, and the FANGs was down 3.6. So valuations come back over here. Valuations have dropped quite a bit. This is essentially telling us that expectations have continued to capitulate through this trend. So from early 2022 until now, we've seen a lot of capitulation with the devaluation or revaluation of global assets. Could continue to move downward, but I believe we're getting very close to setting up some sort of a bottom, maybe over the next 2 or 3 months. Okay, commodity to gold index, same type of scenario. Really peaked out here in early 2022 and has continued to come down into these lower levels. A little doji here at the end, finding some support up near this upper range. This has historically been fairly low area. This was deep low during COVID. So we're back into normal types of commodity activity. Now, obviously, we've got some real issues with gas and other commodities that are a little out of whack, but getting deeper below this 2.1 or 2.0 level down into these levels would represent a very deflationary trend in commodities. So we're down near normal, upper normal levels for support. We could see it move considerably lower. Obviously, natural gas and everything have been disrupted because of the war in Ukraine and supply side issues. But again, we're getting down into these normal channels again, ladies and gentlemen. This means that we could be looking for some sort of an intermediate bottom over the next 3 to 5 weeks or longer. Okay, I think, oh, the volatility index. Oh, yes, my favorite. Now, I've drawn some new ranges here to show you. In uptrends, we get these continuous higher bottoms as it tries to rally higher. And this was prior to 2018. So this was the February 2018 peak, the March, April 2000 bottom, rallied a bit higher. This was the August, I think it was August, September peak when the Fed raised rates to 2.5%, causing the markets to bottom in December of 2018. You can see we've rallied upward through this phase. This was COVID, the big breakdown through COVID, and then we've rallied up through this phase. Now we've come right back down into these areas through the devaluation phase. The volatility index was up 10% last week. Pretty strong move when you consider that all of the major indexes for the most part were lower. So what is this telling us? What is this really telling us? Historically, this is kind of a fairly moderate support level. Yes, we can get lower, deeper washout lows. So we have to be prepared that we could see some sort of a big capitulation washout low taking place. But we could be seeing this as an early 2018 kind of a base here where we've come from our peaks way up here, we've come down to this range here in the 6 area. We may be setting up some support over here for a bit of a moderate churn back up to 10, 11, 12, and we'll see how this plays out. It's fairly indicative of moderate support coming back into the markets, looking for a potential bottom. You can see what happened back over here. We had a potential bottom. We had about 11% rally in the market. Back over here, you can see we had deeper bottoms back up into these areas or these areas, and each one of these moves prompted a 12 to 14% move to the upside from these lows to these highs. So it can be very dramatic. For example, from this low in December up to this high, we had about a 22% rally. From this deep COVID low up to this high, we had a 100% rally in the NASDAQ. From here, if we get back up to 11, 12, 13, this might represent a 15, 20% rally in the NASDAQ, maybe more. So we're looking around here for support, and it may be coming. Okay, I'm going to try to make sure I don't go too far over. Okay, our updates this week. Updates this week. Our selling into the Fed rate hike seems to have hit an apex, what I'm calling capitulation. We might be nearing a bottom. My custom index are suggesting traders are starting to buy into this dip. Although it's too early to tell if recent lows will turn into a bottom, I'm suggesting staying cautious while keeping an eye on the dynamics at play. And I've explained that to you. Foreign capital is starting to look for opportunity in this deeper market, particularly in areas like China, potentially Europe, potentially undervalued stocks like NASDAQ and the FANGs index. For example, there was an article I read the other day that there was a huge influx of money into Cathie Wood's ARKK, the Innovation Fund ETF. And that's telling me that traders are starting to look at this as a potential washout low. They're moving into the markets, possibly expecting a 10 or 15 or 20% recovery from this phase as long as the bottom doesn't fall out of the market. The US dollar strength is likely going to keep driving investments in US assets. Again, depending on how the markets move and how they recover, we could see a fairly strong recovery in gold and silver. I'll show you those here in a minute. But we're going to stay cautious. Our indexes here are moderately bearish on the short term for the S&P, NASDAQ, Dow Jones, and SPY. Still long term, we haven't moved from our bullish stance. And I'll show you these with the rotational modeling system in a minute. We are in 10% in stocks. We are 65% cash. This is the expanded portfolio. We're holding on to some bonds. Bonds have been really underperforming, but understand that the decrease we have in this is very minor compared to the strength we have over here in what we do have. Now, the only reason why I haven't moved out of stocks and tried to protect our investments any further is that we're still having this long-term bullish trend. So understand, we don't make a real big move until we see this thing change into bearish. And I'll show you these here in the next slide. Oops, wrong way. Overall, ladies and gentlemen, everything but oil has moved into this bearish short-term, bullish long-term scenario. And I'll show you these as we move forward. So the NASDAQ, the S&P, the Dow Jones Industrial, Transportation, again, SPY, which is similar to the ES, gold and silver have moved into short-term bearish, long-term bullish. And I'm going to show you these as we move into the next slide area, live charts. Oil is still bullish and moving higher. So this is a scenario where we're getting very mixed signals, kind of a sideways trend. And remember, we had gotten out of this many weeks ago. We had kind of moved into this preparation, moving into cash. We had been in cash for many, many weeks, taking advantage of the opportunity in the US dollar. And now we may look to move back into some stocks eventually as we move into trending. So we will come over to, let me make sure I've covered everything. Oh, let me cover the TT scanner. TT scanner weekly is showing us a couple of new triggers. You can see we have a new trigger here in real estate, has moved down. RWX has moved into short trigger. We have a targets here at 29.79, 27.93. We have a moderate thrust index. You can see we have a new trigger here in the technology sector. This is weekly. This is TT scanner. So this is short-term swing trading. We have a new trigger here, short in consumer discretionary. Consumers are pulling away. We know this. I've been talking about it. Expanded, let me see here, NASDAQ 100 technology sector. We have a new trigger here. So you can see all of these new triggers, these one, new, one. So here we have technology, we have a new trigger short. Software sector, we have a last week, a new trigger short. We have 3 new triggers here. We have 1 trigger here in communications service sector. We have a new trigger here in the Dow Jones Internet Index. So the pullback in the FANGs index has really moved these into bearish trending. We still have long-term trending here. Look at this. Long-term trending 73 weeks ago. Yep, that's right. That's a year and a half ago. We're still in a long trade in healthcare. We have a long trade here in healthcare. We have 16 weeks here in energy. We have 6 weeks here in utilities. It's been moving higher. We've already hit our first target. It's up 2.5%. This is up 34%. This is up 15%. This is up 11%. This one here, this short in the biotech, why I skipped this one, 12 weeks old. It's up 22% already. Very nice. And then we have our oil, XOP. It's been long. We're up 28% in that trade, hit both of our targets. And global energy, IXC, is up 20%. It's been 13 weeks, and we're really doing quite well. This 12-week here with the GNR, the Global Natural Resources, is up 4.89%. It's hit our targets. It's been quite a bit higher. It's currently at 60. It's been up to 64, 65. So long and short of it, it's near our stop. It may be rolling over, and this could be a move where commodities are moving back down into more normal ranges. So now let's come back over here and take a look at some of our charts. This is my NASDAQ chart. And what I'm looking at here, ladies and gentlemen, is this trend channel, this extended channel here coming back down around the support zone. Now, this has historically been support, and I've been talking about this 13,050 level, which is pretty much this line, for quite a while. And what I'm going to suggest to you here is support is a soft layer in the market, and we need to see how markets move around this support layer. Came down and tested the support layer first, acted as a hard floor. Came down and retested it, acted as kind of a soft, watery floor. Rebounded back out of it, prompted a very strong move. Came back down, retested it again, was rejected. Retested it again, was rejected. Deeper selling last week has pushed it into new lows. So based on Fibonacci price theory, this is telling us that price is attempting to break down and attempting to move into new lows on this daily chart. And what I'm expecting, honestly, is this to be a capitulation selling and it to be rejected again, moving back over here. Now, ultimately, we're going to have to watch this level. So this level here, this trending scenario right in here, is going to be what I think is going to become the next major level of resistance, and what I think is going to be kind of a move from here up to here, potentially coming back down, reestablishing support, and then potentially attempting to come back up into this area, which really kind of comes right across here. So you can see this is where I believe we're going back up again. I believe we're testing this area. I'm going to try to make this as thick as I can and change the style, because this is a major support level and this is a major support level. So understand that what's happening in the markets right now is these become our critical peaks and valleys with regards to Fibonacci price theory, and it's close enough. And I want you to understand that these are the areas that price is attempting to break through to establish new highs and lows. We're obviously down here in this new low area. I'm calling this a support zone because it hasn't clearly broken through. But what I'm going to tell you is we could see this bit of recovery and could be back into this range, attempting to establish a new tighter range. And what would happen if the markets came back up? Let me get rid of this and get rid of this and get rid of that. What would happen if the markets came back up and attempted to establish a new range from this area? Hypothetically, let's say this is a capitulation low and the traders are going to buy back into this, possibly move the market from here. Oops, wrong one. From here up 10 to 15%, maybe a little higher. So 10 to 15% would put us somewhere up in this area. So let's assume from possibly this area to this area as an upside move, hypothetically. And then what? What would happen here if we're unable to establish a new high? We would establish a new higher price critical level here, potentially move downward, reestablish some support, try to figure out where we're going to go next, maybe retest these lower levels, and then eventually somewhere either break out to the upside or break down, breaking through these lows. So this is kind of what I'm expecting the markets to do over the next, between now and the beginning of Q3 or early Q3. So we'll see how this plays out. Now let's come over here to trade tank charts. Let's go through the S&P. I drew this last week. We'll get rid of it. I've talked to you quite a bit about all of this. See, bearish daily, bullish weekly, still green. We're in a lighter green color, which means we're seeing some weakness. This is strong green. This is moderate bullish. So we're still bullish, but we're moderate bullish. And again, these are the systems that I run, the modeling systems that I run to try to tell us how we're going to model our investment criteria. So this is what I drew last week with regards to a breakout potential pattern. And you can see here that we are still green, bullish weekly, bearish daily. So we're in bearish daily trending. The YM, bullish weekly, bearish daily. You can see we've moved into bearish, but we're still trying to find this support. We still have, in this area, we still have support right across here that is acting as a critical level for the markets. So we need to kind of see how that plays out. The gold is bullish weekly, moved to bearish last week off of this deep selling. You can see this big pullback. But again, pay attention to the strength in gold. Dollar's been moving considerably higher for many months. Look at this strength in gold. Solid green trending. I mean, going all the way back to the COVID lows here, 2018, excuse me. COVID didn't even change right here. So this was the 2018. We rotated. We went back to bullish back here in 2019, and it stayed bullish the entire way. Silver, on the other hand, has been very flat. And you can see we've moved into weakening pink bullish trending on the weekly chart. And we've moved into bearish trending here on the daily chart. We're back into this support zone, which is really a wonderful buying opportunity down here. 22 bucks or lower looks really solid. Okay, let's go to crude oil. Well, obviously, crude oil at $110 is continuing this little apex. Now, I will warn you that this apex move here, this little breakout move that we saw last week, could be a bit of a false move. So when we get into an apex move like this, it comes up, comes back down, comes back up, comes back down, and then we get this breakout. It may be that this is a false move to the upside, suckering in traders potentially, and it may rotate back down, try to find some support, consolidate, and then maybe break down a bit lower. So we'll see how this plays out. But trading oil right now and natural gas may be fairly dangerous with this little false breakout move. We may see this roll quite a bit lower back to the downside next week. So we'll see. Natural gas, same type of scenario, big move to the upside. You can see we've consolidated here, still bullish. This is bearish, believe it or not, trying to rotate higher. And I have to take a look at this, but long and short of it, bullish daily, bearish weekly, very consolidated, looking for a potential topping scenario here. Could go quite a bit higher, but ladies and gentlemen, I would be very cautious of this. Let's go to the SPY. SPY is still bullish weekly, bearish daily. You can see we've got this support system down here. I drew this line last week. I'll draw across here. Close enough. Okay, so this is our support level, and we're still bullish long term. Now, we could see this change weekly. It could happen next week or the week after if we see some deeper selling. But like I said, I think we're looking at some real potential here for a bottoming formation in the market. Let's take a look at the transports in IYT. IYT is bullish weekly, bearish daily. Financial sector, IXLF, is bullish weekly, bearish daily, just went bearish. We've got this moderate little pullback to new lows. We'll see how this plays out. I think, like I said, I think everything's going to be looking for support over the next couple of weeks. Let's come down to TLT. We are seeing deep selling in TLT. Like I said, we're holding a very small position in this. And the point behind this is that we're getting very close to deep lows, very deep lows here. The point behind this is we've got a very small position. When this turns, we will load back up in on it. The US dollar is still moving higher, which is where most of our capital is. Let me see if we have this. Here's the US dollar index. You can see that weekly it is bullish. It's been moving up quite a bit. We have been in cash, a 25 to 85% cash position for the last 8+ months. And you can see here, ladies and gentlemen, we've gone up in this scenario from roughly here to here. We've gone up 12% in our cash position. Metals have gone up. We come back over here, just take a look at gold. We have 25 to 35% in gold, and we've been holding that position for quite a while. We saw this rally up, but we've seen from the middle of last year, basically, call it from over here, we've seen a current level 7, 8%, 9% move, and up near these peaks a 15% move. So what's happening is we've eliminated our risk by reducing our positions to 5 or 10% in certain assets. That means that even if that were to move down 10% or 11% in stocks or bonds, we're taking a potentially 1% or less than 1% risk on that position so we can get back into it. And we're just watching for these bottoms to take place. So now we come back over here, and what I'm going to show you is this is a monthly gold chart using my TT Charger V1, and these are the cycles that have played out. You can see we've started a new cycle trend here. I believe we're going to see a nice solid upward move. What I'm saying here is gold is going to continue to potentially rally through most of this cycle, and I believe it could continue to really break as we get closer to the end of this cycle, which is 2028, November, December 2028 and 2029. When we take a look here at the S&P, I've drawn these for presentation in videos, but I'm going to show you here from these levels. I really believe we're looking at a deep, deep low. So here, I'm going to show you, see if I can do this from these lows. This is the 2009 low. What I believe we're looking at here is an A, B, C move to the upside. This creates our one wave, A, B, C, one wave. Wave, let's call it 2 to the downside, is the COVID collapse. That is our correction from 2009. It's a deep enough correction above this deeper low here, meaning that this would be our B correction or our wave 2 correction. This would be our wave C correction. Now, where we're at right now, this is the start of a new wave 3. If my count is correct and this is a wave 4, then this becomes a wave 5. If my count is incorrect and it's an alternate count, and we have A, B, C to create wave 1, we have a wave 2 down, we may get another A, B, C to create wave 2 somewhere up here, maybe up in this range, and then we would have a correction. Try not to shrink it too much. We would have a correction down into kind of like we had to begin with, from there possibly down into this area, and then we may start another A, B. I'm on a different mouse pad today. C correction move to the upside. So understand that we've got a lot of dynamics at play in the market right now. And what could prompt this kind of a move? Well, we've got huge Fed spending, we've got lower interest rates, we need to grow ourselves out of this debt level, this debt to GDP ratio. And the way this could happen is a global market, restructuring of debt and liabilities, and essentially a devaluation or revaluation of global market assets that really, since 2000 or 1999, if you look at it, from back in this area. I don't have a lot of data. Well, it's only going 5,500 days back. So from the 1990s, mid 1990s until roughly back over here, where China and Asia had really seen a massive growth. This was a global growth period where the US markets were funding expansion in Asia, factories, consumption, global growth. The Fed stayed extremely low, quantitative easing, easy money policy, pumping out money, trying to keep this growing. Well, what's happened now is we've gotten into a high debt level, and Fed's trying to raise rates. Asia's contracting, Europe's at war, China's contracting. What happens next is very similar to kind of what happened in the 30s, 40s, 50s, and 60s after World War II and the Korean War and the Great Depression. What happens here is if the U.S. can continue to navigate this efficiently, the U.S. could provide a very strong economy for global growth over the next 15 or 20 years. Yes, we could have these big pullbacks. Yes, they could be fairly disastrous. So, example, if we go A, B, C to 1, excuse me, counted that wrong. No, that's correct. A, B, C to 1, B to 2, A, B, C to 3, down to 4, A, B, C to 5. These could be deeper. These could essentially, each one of these corrections could move down into these areas. So this is a deeper correction of this first wave. This would be a deeper correction of this second wave. And then I'll draw it to here because, see if I can get it horizontal. This would be, oops, our correction phase. These would be the down waves. So let me change these, turn them into a little pinkish color, and turn this into a pinkish color. These are our down waves. So understand that in these down waves, they can come down to the lower portion of this deeper bottom. They can come down to the lower portion of this deeper bottom and still continue. But eventually, if my count is correct, we're still in an extended upward trend, which means there's huge opportunity for the markets if you're playing the right side of this. Okay, so what I'm going to do is I'm going to leave you there, and I'm going to remind you that we need to really pay attention to what's going on over here with the volatility index, and we really need to pay attention to what's going on with this global index here, in the sense that this is showing us that we're nearing support. We could be nearing a bottom. This could be the beginning of a new upward phase that might be very extensive. We need to see how this plays out and stay protected. If you had been following my research over the past couple of months, you would have been protected back over here in 2021 and prepared for this. I've been warning you about this for quite some time. But now that we're at this point, we're going to stay in our protected, cautious mode, and we're going to start looking for opportunities if they set up over the next 3 to 6+ months. And I think it's going to really freak people out because, like I said, if this holds up as support and if my analysis is correct, then we're looking at the biggest expansive phase that's going to take place over the next 6 to 10 years, possibly longer, while gold and silver continue to skyrocket. And why? Because they've been completely undervalued as far as fear and as far as an asset in the world. So if we come, I'll show you, I'll post up a gold and silver ratio chart. They have been completely undervalued. Right now, with the market the way it is, the gold should be trading around 26 to 2,800, and silver should really be up around $40-45 an ounce. But they're trying to keep it down because they're using it as a stipulation for financial fiat currencies. And if you follow what's actually happening, global nations are accumulating gold and silver because they know that it is a real asset. And that's what I want you to pay attention to. All right, that's it for now. Kind of a long video, but we're good. Talk to you later.